In this video, guys, we're going to look at a 3D trade, which is about divergence across three correlated markets. Great one for day traders. Hey traders, a warm welcome to you. Okay, so the 3D trade or 3D system is a way of looking at three correlated markets and making a day trading decision based on how those three are correlated. So, example in front of you, I have top left screen QQQ, which is the Nasdaq ETF. Top right screen I have SPY, which is the S&P 500 ETF. On bottom left I have DIA, which is the Dow Jones ETF. Bottom right I've just got Amazon on here for now. Ignore that, just that it's easier to put on 4 charts with TradingView than it is to put on 3. Now bearing in mind you can have a fourth on there if there's something correlated. Perhaps it's something that you can use a currency pair or what have you. And by the way, you can use this not only in stocks. I've just chosen with ETFs, index ETFs. You can use it in stocks. You can use it in commodities, like you have gold, silver, platinum on there. You could have it in with energy, like you could have crude oil, natural gas, heating oil, currencies. You could have your selection of your major pairs that all have a similar dominant pair in them. However you want to package it, you can work out the correlations for yourself. But how we trade it is this: we wait to see if one is specifically weaker than the other or stronger than the other two, and we do that by looking at divergence across the charts. Let's have a look and see. So on the left hand side here I've got the Nasdaq, and you can see now, if I kind of zoom in a little bit on this, and bear in mind I appreciate these are squashed up a little bit for the screen, but they'll do the job so we can see what we're kind of talking about. If you want to dig into it a bit more, by all means, bring some charts up on your own screen, have a look. We've got a high here, then we barely get to a high. In fact, we don't close at a new high. It's almost like there's a resistance level there. So whatever time that is, it's 20 past 3 UK time, so almost an hour in. 5-minute charts, by the way, these are, guys. But we look at the Dow ETF. Fresh highs, it's still rallying to highs down here. We look at the S&P 500 ETF, again fresh highs. So what information is that? That is telling us that the Nasdaq is weak, and if we think we have a short opportunity, we are going to short the weakest one of the three, in which case it is the Nasdaq. So if we see that, if we see a double top, then we decide to go short here. We don't start shorting the Dow, we don't start shorting the spiders, we short the Nasdaq because it's the weakest of the three. Now, is it going to roll over? We don't know, but the point is, if we align ourselves with the weakest when we're going short and the strongest when we're going long, it means that we've got a better chance of the trade working for us. If we're wrong completely, we're wrong completely, but if we're right, we're going to get more meat on the bone. And as you can see here with the Nasdaq, it starts to roll over. We are basically taking out lows just as the Dow is coming back into its initial opening range. Same with the S&P 500. We don't even take out the low yet. We're still within the day's range, whereas the Nasdaq's well and truly taken out the low. So the meat on this trade is way more than it is. If you went short the Dow, you wouldn't even taken out the lows. Look at this Nasdaq here on the top left where my cursor is now. We're at way fresh lows. Well into new territory, almost filling that gap from the prior day. On the Dow, we haven't even taken out the low. We're nowhere near that gap. S&P's a little bit weaker, but it's not as weak as the Nasdaq. So a short in that circumstance would have paid off way better on the weaker one of the three. Now let's look at a different example. For example, now we're going to look at, let's say we're positioning long. And by the way, this isn't saying, oh, you must position long or short specifically for these trades. It is if you have a short thesis on the broad market, on your daily, whatever it is, go to the weakest intraday. If you have a bullish thesis, go to the strongest intraday. So you've got a bullish thesis, you're looking to buy some point in the opening hour, whatever that may be. Okay, the market opens, you see the Nasdaq opening at high where my cursor is here on the top left. We drive lower, it's quite weak. Look how that compares to S&P 500, which doesn't take out the low, compared to the Dow, which actually flags at highs. So immediately now we can see if we wanted to go short, we're going to be shorting the Nasdaq. If we wanted to go long, we're going to be going long the Dow. Example here, if we go long the Dow, look how much extra we get in this, or the Dow ETF should I say, compared to going long the Nasdaq. The Dow is at fresh highs, it rallies really aggressively, even on this point here where you can see we've got a reasonable high. We don't even hardly go to a new high here on the Nasdaq, whereas the Dow down here has done another fresh leg. So it's important to see to identify the weakest or the strongest in the group that you're trading. If you don't have a specific thesis on one or the other, you just have a broad thesis, then doing this kind of research or doing this analysis into the market shows you where the supply demand imbalance is likely to be. Same if we gone short Nasdaq, right? Went short Nasdaq, let's have a short thesis on Nasdaq, we would be losing money 4 bars down the road on the Dow. However, if we went short the Nasdaq, we would be in the money 4 bars down the road. Subsequently, it turned into a loser, but look how long that took before it came back to break even. We're at 4 o'clock. By this time, the Dow at 4 o'clock is almost double the range it's already done. So the point is, even if we're wrong, we're not going to be as wrong, and that's the idea, guys. We align ourselves with the strength and the weakness. If we're wrong, we don't get hit so much, and when we are wrong and when we're right, we really milk it compared to making it hard for ourselves by buying the weakest. We buy the strongest. If it's exhibited strength and we can see that relative to others, we go long on that if we've got a thesis there. If it's exhibited weakness, we don't go long on that at the very least, or we look to short it if we've got a short thesis. Anyway, guys, it works well with commodities, like I say, some currency pairs, stocks that are in the same sector, indices, anything where there's some kind of correlation. It's a good strategy to use. Anyway, guys, take care. Whatever you do, keep the risk managed. I'll see you in the next one. Bye bye.